Imagine stepping into a store or maybe, browsing online for that sleek new car you've been eyeing, and you find the price tag is clearer, simpler, maybe even a little bit lighter than you expected. Or conversely, you're wondering if that dream bike you wanted has suddenly jumped into a whole new tax bracket. That's the kind of potential shakeup we're talking about today. Welcome to the deep dive. Today, we're taking a closer look at a proposed financial overhaul in India, sometimes being called GST 2.0 rationalization. Our mission: to unpack the expert insights from the financial reports we have here and really drill down into what these proposed changes could mean, how goods are taxed, when these changes might actually happen, and maybe most importantly, what it means for your wallet, especially if you're thinking about a new vehicle. And, well, for the entire auto industry, too. We're talking about a major tax simplification. It promises clarity, but, yeah, it also raises some fascinating questions about what exactly gets labeled luxury in this new setup.
It's a massive undertaking, definitely. And you've hit on the core challenge and I guess the opportunity there. The current goods and services tax system, GST, with its multiple layers, it can feel less like a streamlined system and more like, well, a bit of a labyrinth sometimes. So the basic idea behind GST 2.0 is to radically simplify that structure, move towards something much cleaner, more intuitive. In theory, anyway, it should be easier for businesses to manage and for consumers like you to understand. But like you said, the devil will absolutely be in the details and the fine print of these new classifications.
Okay, let's unpack this grand simplification then, starting with GST 2.0 and sort of broad strokes. Right now, the GST framework works with four main slabs: 5%, 12%, 18%, and 28%. It's small, it's complicated. And the auto sector, for the most part, has found itself sitting in that highest 28% slab, plus often with an additional compensation cess piled right on top, pushing the total tax burden even higher.
Exactly. And what's really interesting here is the proposed structure that seems to be coming from the finance ministry. They're looking at moving to a much leaner three-slab system, which means the current 28% slab gone. It would basically merge with the 18% slab. And similarly, the 12% slab would also be eliminated, absorbed into the 5% category. So the new vision is pretty clear-cut: 5% for essential goods, 18% for the vast majority of goods and services. And that 18% slab is actually expected to pull in like 80% of all GST collections. That's huge. And then a distinct 40% peak slab specifically for what they're calling sin goods, things like tobacco.
Right, that three-slab system definitely sounds simpler on paper. And this isn't just some, abstract technical change for accountants. It's about making the tax system drastically simpler to navigate for everyone, from small businesses managing their books to you, the individual shopper, just trying to understand the price of your next big purchase. Less complexity usually means more transparency, right? And that can really shift consumer confidence. And speaking of shifting, what makes this whole situation really captivating is the speed, the sheer speed at which these huge changes could actually impact your purchasing decisions. The group of ministers, the GM, they've apparently already given the nod to this three-slab structure. Now, the big date everyone's watching is the GST Council meeting. It's expected to happen on September 3rd and 4th, 2025. That's when they're supposed to finalize this new rate structure.
Indeed, the timing here is very strategic. It tells you a lot about the government's intention. Reports are suggesting this crucial GST Council meeting was actually moved up, preponed, from its original slot later in September. Why? Well, to make sure that if the new rates are finalized, they can be notified within just a few days. This is absolutely critical so that the industry doesn't miss out on the vital festive season sales, which, for a huge part of the Indian market, kicks off right in September 2025, and the GMM's prior approval. That strongly suggests that quite a bit of groundwork has already been laid. It sort of sets the stage for a potentially remarkably swift implementation.
So this quick timeline means your festive shopping plans. They can turn from just a casual decision into almost a strategic game of timing, especially for big-ticket items. Imagine having to decide, do you rush to buy before potential price increases, or do you hold off? See if a price drop happens for the car or bike you want. It's turned the annual shopping spree into a bit of a strategic financial play for you, the consumer. Okay, now let's talk about something that's been a bit of a financial anchor on many auto purchases: the compensation cess. When GST first rolled out, the central government basically offered the states a safety net, right? Promised to compensate them for any revenue losses for 5 years. It was meant to smooth the transition.
Exactly. And that safety net was, it was crucial for getting all the states on board with GST in the first place. That initial 5-year window for compensation, it actually expired back in 2022. Now, while an extension was granted until March 2026, With such a massive reform to the entire GST structure now seemingly on the table, there's a very high probability that the compensation cess, which, as you pointed out, often added a pretty substantial chunk to auto taxes, will be discontinued. It's a bit like, taking away a crucial financial crutch the states have been leaning on. So the question isn't just about discontinuing it, but how they'll manage without that sort of steadying hand.
That's a really insightful way to put it. And for you listening, this isn't just bureaucratic jargon. It's a direct, potentially tangible cost reduction. It could benefit consumers quite a bit, assuming, of course, that those savings are genuinely passed on by the companies. It could be a truly big deal for the final price tag of a new car or bikes. But okay, if rates are cut and that compensation cess is discontinued, a very natural and very big question comes up. How is the government planning to bridge that potential revenue gap? Where's the funding going to come from?
Ugh, the million-dollar question for any major tax reform, isn't it? The government seems to be looking at two main strategies to fund this potential gap. First, there's a strong expectation, or maybe hope, of a marked rise in consumption after the rationalization. The idea is a simpler system, maybe combined with lower prices for some goods, will spur overall economic activity, and therefore lead to increased tax collection across the board, even if individual rates are lower on some things. The sort of insight here is that the success of GST 2.0 isn't just about the numbers on the spreadsheet. It's also about the perception of a simpler, more stable tax environment, maybe fostering a growth mindset across the economy. And second, there's the possibility of a targeted rise in taxes for certain sin goods, like tobacco, as we mentioned, to offset some of the losses from other areas. However, it really does remain to be seen precisely how the central government will structure compensation, if any, for states if they do experience revenue loss from these changes. It's a very, very delicate balancing act, trying to ensure both federal and state budgets remain stable without, stifling the very growth they hope to achieve.
So they're banking on both increased consumption and sin taxes. But history tells us that a marked rise in consumption can be, well, tricky to predict, especially with big economic shifts. Are there any specific indicators or past precedents that give the finance ministry this confidence? Or is it more of a sort of calculated gamble on overall economic sentiment?
That's a crucial point, and while the official line seems to be banking on the general boost from simplification, it is a projection. Historically, these kinds of rationalizations are often accompanied by a temporary dip before growth maybe stabilizes or picks up. The confidence likely stems from looking at broader economic trends and, fundamentally, the belief that a less burdensome, more predictable tax system unlocks inherent market potential. So maybe less a pure gamble and more a strategic investment in the long-term efficiency of the economy. But yes, certainly it requires very careful monitoring as it rolls out.
That makes sense. It's about understanding that whole economic ripple effect and the really complex balance the government's trying to strike to make the system work. Okay, now let's zoom in on the automobile arena. This sector, as we touched upon, is currently a bit of a maze. All these different GST rates and cesses, trying to figure out classifications based on engine size, vehicle length, ground clearance, even fuel type. It sounds like a quiz show only a tax expert could win. We're talking rates swinging from, 29% for small petrol cars all the way up to 50% for large SUVs. It's a lot of confusion for buyers.
Absolutely. The current system is fragmented, no doubt. It creates a pretty opaque pricing structure for consumers. But the proposed simplification really aims to bring a lot more clarity. Let's try and break down who might benefit and where this new luxury threshold could potentially land. For instance, electric vehicles, EVs, and tractors. They're likely to settle at a 5% GST rate. For tractors, that's quite a notable reduction from their current 12%. And it directly addresses an existing issue called an inverted duty structure. That's basically when the tax on the final product is lower than the tax on its parts or raw materials, which can discourage making things locally. So fixing that is good. Then, for a really significant chunk of the market, think small cars, two-wheelers up to 350cc, three-wheelers, and commercial vehicles, or CVs. These currently attract 28% GST. The report suggests these are all likely to reduce to 18%. Now, that would be a pretty substantial cut for these segments. It could fundamentally change their pricing. Although it's worth noting, for two-wheelers, some reports mention that the benefits might be slightly offset by the recent ABS mandate, which adds to manufacturing costs. But still, likely a net positive overall. Okay, now for the proposed new luxury category. This would fall under that new 40% peak slab we mentioned, SUVs, for example. Currently, they face GST rates anywhere between 43% and 50%, depending on their specs. They are now expected to fall under this new 40% rate. So while this is still technically a cut, it's a smaller benefit compared to segments like small cars or the smaller two-wheelers, meaning their price points, while probably lower, might not see the same kind of dramatic shift downwards. But here's where it gets really contentious. premium two-wheelers, specifically those over 350cc. The crucial question hanging in the air is whether these will be classified as luxury and therefore pushed into that 40% GST rate. This is a key area where the definition of luxury, doesn't include bikes over 350cc or maybe even over 250cc, is absolutely critical. Because if these premium two-wheelers are indeed classified as luxury, their GST rate would actually jump significantly from the current 31% all the way up to 40%.
Wow, yeah, that's a huge potential jump for premium bikes. Is there any clear rationale emerging for why a bike over 350cc might be considered luxury, in the same bracket as a large SUV? Especially when, many people use them for daily commuting, albeit maybe more premium commutes. It feels like a very different kind of purchase.
That's precisely the debate probably happening right now behind closed doors. The rationale, if I had to guess, likely hinges on a broad interpretation of discretionary spending or perhaps aspirational purchasing power, rather than looking purely at utilitarian use. For some policymakers, maybe a larger engine capacity automatically signifies a premium product, regardless of how it's used day to day. But you're absolutely right. It presents a significant challenge for manufacturers in that specific segment and could potentially fundamentally reshape the market for those kinds of bikes. It's a real test of how they end up defining luxury beyond just the price tag.
That's fascinating. And it directly connects to the vehicles you might be thinking about buying or driving. It gives a much clearer picture, potentially, of what your next car or bike might actually cost. But it also really highlights the nuance, maybe even the controversy, in defining what luxury truly means in a market as diverse as India's. Now, while these rate changes are definitely the headline-grabbing news, they're rarely the whole story, are they? What else should we, and you, the listener, be looking out for? Things that could shape the real-world impact of these reforms beyond just the numbers on the spreadsheet.
That's a very important question because the actual benefits reaching you, the consumer, depend on several other, maybe less obvious factors. One major item to watch out for is the anti-profiteering clause. The government's decision on whether to reinstate this clause is critical. This clause would essentially compel manufacturers, the OEMs, to pass on the full benefit of any rate cuts directly to consumers. Without it, there's a genuine concern, as you hinted earlier, that OEMs might just absorb part of this benefit, maybe through reduced discounts or just by widening their own margins, meaning you might not see the full price reduction you expected. And the previous anti-profiteering end date has already expired, so its reintroduction is a key uncertainty. Another area to keep an eye on is fleet operators. Currently, they have a couple of options for GST. They can opt for 5% GST, but without getting input tax credit. That's the ability to claim back tax paid on their business inputs, like fuel or maintenance, which is vital for their margins. Or they can choose 12% GST with ITC. Now, if the government decides to mandate a fixed 5% rate without ITC for everyone, well, then those operators who currently use the 12% route would lose out on that valuable tax credit. That could significantly impact their business models and eventually maybe even the cost of services like ride sharing or logistics. We also need to watch state-level incentives. Many OEMs currently benefit from various state government incentives. These are often tied to the amount of GST collected by that state from those specific manufacturers. So, if the GST rates are reduced, leading to lower overall collections for the state from that factory, it remains to be seen if states will then cut back on these incentives for the OEMs. That could, in turn, impact manufacturing decisions and perhaps overall costs for the companies down the line. And finally, there's the very practical challenge of dealer inventory losses. It's almost unavoidable. If new, lower rates are implemented, there will inevitably be existing stock sitting in dealer showrooms that was taxed at the older, higher rates. OEMs are likely expected to bear the cost of these inventory losses to support their dealers. Now, while it's probably more of a short-term timing issue than a major long-term impact, and faster-moving models will be less affected than slower ones, still, slow-moving models could see some impact as inventory takes longer to clear out. OEMs will really need to manage their stock liquidation strategically around whatever single cutoff date is announced for the new GST structure just to minimize disruptions.
Right. These are those crucial, often overlooked details, aren't they? They'll truly determine if the intended benefits of this whole GST 2.0 plan actually reach you, the end consumer, or if they somehow get absorbed somewhere along that incredibly complex supply chain. It really is like a sophisticated game of chess unfolding. Well, this has been a really comprehensive look at what could be a genuinely transformative moment for the Indian economy, and certainly for anyone who's in the market for a new vehicle. We've talked about the major shifts planned for the GST slab structure, the critical timing around the festive season, the potential discontinuation of that compensation cess, and the very nuanced impact on different auto segments, especially that crucial and maybe controversial definition of luxury.
And that really leads to a profound thought, I think, for you, the listener, to consider as this all unfolds. How will the ultimate definition of luxury, whether it ends up being an SUV or a premium two-wheeler or perhaps something else entirely, how will that definition truly shape things, not just market prices and your immediate purchasing power, but maybe also consumer aspirations and even the very direction of innovation within the automotive market for years to come?